Hello friends, in this particular lecture I am going to deal with revaluation and its impact on financial statements. We have a problem in front of us. Let us straight away go ahead with the problem. So there is an equipment, the cost of which is 10 lakh rupees, life is 10 years. The estimated residual value is not provided in the problem, hence we assume it as 0. The problem allows SLM method. At the end of second year, the asset was revalued to 10 lakh rupees. At the end of sixth year, it was revalued to 6 lakh rupees. That means there can be some revaluation profit or loss which we would have to compute. Tax rate is given at 30%. Take profit before deduction and taxes 5 lakh each year. Assume SLM method is allowed for tax purpose as well. So how do we go about understanding the impact of revaluation on our financial statement? Let us go ahead. Let us start with first calculating the depreciation for the each year. We'll also learn how to calculate the accumulated depreciation, the WDV of the asset at the end of the year, the revaluation profit, revalued amount. Let us go ahead. So the life of the asset is 10 years, hence I'll take the life as 10 years. The first year the cost is 10 lakh rupees, hence I take 10 lakh rupees as the cost of the asset. Depreciation for the first year would be the cost of the asset minus the residual value, that is 0, then we divide it by the life of the asset, 10 years. For the first year, accumulated depreciation will be equal to the depreciation for the current year. WDV of the asset would be equal to the gross carrying amount of the asset, minus accumulated depreciation. In the first year there is no revaluation profit and there is no revalued amount, hence I'll put not applicable here. Now in the second year the gross carrying amount of the asset will remain at 10 lakh rupees, the depreciation would remain at 1 lakh rupees. Accumulated depreciation would now become the opening balance plus current year depreciation 2 lakh. The WDV, the formula I'll copy, it will be 10 lakh minus 2 lakh, it will be 8 lakh rupees. Now at the end of second year the asset was revalued to 10 lakh rupees. That means there is some revaluation profit of 2 lakh rupees. Now how are we going to give effect? Here we have to pass two entries. The first entry is we have to remove this accumulated depreciation and we have to adjust it against the historical cost of the asset. We will pass an entry here, accumulated depreciation account debit to equipment account 2 lakh rupees. So what I am doing is I am writing off the entire accumulated depreciation, or I am closing the accumulated depreciation balance and I am transferring it to the asset account. Okay. Apart from this, once I pass this entry, the balance of the asset will reduce from 10 lakh minus 2 lakh, it will reduce to 8 lakh, but now I have to show it at 10 lakh rupees, hence I have to recognize a revaluation profit of 2 lakh. I'll pass an entry again here, equipment account debtor revaluation profit 2 lakh to revaluation surplus 2 lakh rupees. So I have to pass an entry for recognizing the revaluation profit as well. Then I have to pass one more entry at the end of second year, that is for recognizing the deferred tax asset, revaluation surplus account debtor to deferred tax liability. Why we have to create deferred tax liability, we'll discuss this in another lecture. On 2 lakh rupees I have to create a deferred tax liability of 30%, that is 60,000 rupees. So these are the three entries we are going to pass at the end of third year for the purpose of giving effect to revaluation. Okay. Now we come to the third year. Now in the third year the gross carrying amount would be historical cost minus the accumulated depreciation figure, historical cost minus accumulated depreciation figure, plus I have to add the revaluation profit to arrive at the new carrying amount of the asset. Now depreciation for the third year has to be again calculated based on revalued amount minus residual value 0, entire thing now divided by only 8 years, because the life of the asset is only 8 years. I have to now divide it by 8 years to arrive at the depreciation for the third year. Now accumulated depreciation for the third year would be again equal to 1,25,000, because this figure has already been adjusted against the carrying amount of the asset. WDV, I'll copy the same formula. Revaluation profit and revalued amount for the third year are nil. There is no revaluation profit or revalued amount. Actually up to 6th year we don't have this problem, hence we can copy it safely here, because again in 6th year we have revaluation. Now for the 4th year the carrying amount will continue at 10 lakh, depreciation would be equal to 1,25,000, accumulated depreciation would be 1,25,000 opening balance plus current year depreciation 2,50,000. WDV would be 10 lakh minus 2,50,000, 7,50,000. 5th year again the gross carrying amount will be the same, depreciation would be the same, accumulated depreciation would be 250 plus 125, 3,75,000. WDV would be 6,25,000. Okay. Next, in the 6th year the opening balance of the asset is 10 lakh, depreciation remains the same at 1,25,000. Accumulated depreciation would now become 5 lakh rupees. 375 plus 125 is 5 lakh rupees. The WDV of the asset would be again 5 lakh rupees, but on this date the asset was revalued to 6 lakh rupees. That means there is some revaluation profit here. So revaluation profit would be 6 lakh minus 5 lakh, 1 lakh rupees. I have to again repeat the same set of entries to give effect to the revaluation. But here I have to first knock off the entire accumulated depreciation of 5 lakh. From third year beginning up to 6th year ending there was an accumulated depreciation of 5 lakh. So this 5 lakh is first of all adjusted against the gross carrying amount. That means I'll pass an entry accumulated depreciation account to equipment. Because of this the carrying amount of the asset will reduce by 5 lakh. Then I have to do a revaluation increase of 1 lakh. I pass an entry here. I recognize a profit of 1 lakh rupees. So I book a profit of 1 lakh rupees. Then I have to recognize a deferred tax liability of 30,000 now, because 1 lakh rupees into 30% is only 30,000. So I recognize a deferred tax liability of 30,000. Now at the beginning of the 7th year the carrying amount would now be 10 lakh minus, I have subtracted the accumulated depreciation against it, and I have to add the revaluation profit. This is the impact of the entries. Now depreciation for the 7th year has to be recalculated again. It will be based on revalued amount minus residual value, entire thing divided by remaining life. It's now only 4 years. Accumulated depreciation would be again equal to the depreciation for 7th year, because this amount has already been adjusted against the carrying amount of the asset. Okay. Again we don't have any revaluation in the 7th year, hence we need not worry. Actually up to 10th year we don't have to worry about revaluation and revaluation profit. 8th year the carrying amount will be the same, depreciation would be the same. Accumulated depreciation for the 8th year would be opening balance plus the current year depreciation. This would be the same. Again 9th year opening balance will be same, depreciation would be same, accumulated depreciation would be now 4,50,000. In the last year the carrying amount would be the same, the depreciation would be the same, and the WDV of the asset would be the same. Okay, so this is how we compute the depreciation and the revaluation profit. Now let us come to the statement showing calculation of deferred tax liability increase or decreases. Year again I'll take 1, 2, 3, I'll fill it up. Now WDV as per books, first year it was 9 lakh rupees, but second year it was increased to 10 lakh rupees because of revaluation. What I'll do is I'll give you a simple calculation. Actually the WDV was 8 lakh rupees, then we added 2 lakh rupees of revaluation profit, because of which it became 10 lakh rupees. WDV as per tax is the same. Now third year WDV as per books is 8,75,000 as per earlier statement, then 7,50,000, then 6,25,000. But in the sixth year actually WDV was 5 lakh, but we have to add revaluation profit of 1 lakh, based on which it became 6 lakh, then it became 4,50,000, 3 lakh, 1,50,000, and by the end of last year it was 0. Now WDV as per tax, for the purpose of tax, revaluation profits are ignored. We follow the block of assets concept, where we do not add revaluation profits for the purpose of calculating depreciation under tax. So the first year it was 9 lakh rupees, that is 10 lakh minus 1 lakh. We are assuming that the same amount of depreciation is allowed as per tax also. Okay, then second year we can say it is 9 lakh minus 1 lakh rupees, that is the depreciation for the second year. You can continue to take the same calculation. So here we see only 1 lakh rupees is being depreciated every year, that is based on original costs. So there is no impact of revaluation on the calculation of depreciation for tax purpose. Now let us compute the difference between the WDV as per books and WDV as per tax. First year there is no difference because there was no difference in the cost for tax purpose, books purpose. There is no difference in depreciation for the first year and first year, but second year onwards you can see that there is a difference between the WDV as per books and as per tax. Now I'll take the tax rate here. Let us assume that tax rate remains constant for all the 10 years, 30%. Now closing balance in the DTL account would be the difference multiplied by the tax rate. You will get the closing balance in the deferred tax liability account. Now if you observe, in the second year there is an increase in deferred tax liability. First year there is no increase, but in the second year there is an increase of 60,000. So that means this is an expense. We have to provide for this expense. Okay, where we are going to show this, I'll show it when we prepare the P&L account. Let us copy the formula here. So in the second year we have recognized deferred tax liability. We are actually creating a provision. We have created a provision, deferred tax liability. Here we have passed an entry. It is current tax expense account data to deferred tax liability. The 60,000 will be subtracted from revaluation surplus, not from our profit and loss account. And then there is a reversal. Here I'll mark it as expense. These are incomes. But in the sixth year actually there is 30,000 expense and 7,500 income. There is a reversal happening of 7,500, and this 30,000 is the increase in deferred tax liability due to revaluation. This 30,000 is 1 lakh into 30%, 30,000, and this reversal is 7,500. Okay, and after that we have only a reversal. The deferred tax liability balance is reducing every year by 15,000. When the deferred tax liability balance increases, it becomes an expense. When it reduces, the reduction is considered as an income. Here again there is an increase, but this increase consists of an increase and also a decrease. Okay, so this again is decrease in deferred tax liability, which becomes an income. So now we'll see how to deal with the profit and loss account from year 1 to year 10. As the problem said, we have to assume that the profit before depreciation and tax is 5 lakh for all the years. Let us take that as 5 lakh for all the years. I'm marking 5 lakh rupees for all the years. Now what is the depreciation for the first year? The depreciation for the first year was 1 lakh rupees. Second year was also 1 lakh rupees. Third year it increased to 1,25,000. That means there is an increase in depreciation of 25,000 because of revaluation. Fourth year it was 1,25,000. Fifth year it was 1,25,000. Sixth year also it was 1,25,000. From the seventh year onwards it became 1,50,000 because of further revaluation. 8th year, 9th year also it was 1,50,000. The last year it was 1,50,000. So we have taken the depreciation figures as well. Now we'll try to arrive at the profit before tax. We can simply take a formula. This minus depreciation will be your profit before tax. I'll copy down the formula here. So we have arrived at profit before tax. Now the tax expense, current tax, this is based on tax provision. Current tax is always based on tax provision. So what are we going to do it? We are going to take the profit before tax, we are going to add back the depreciation for books purpose, we are going to subtract the depreciation for tax. Now by doing this I'll get the taxable profits. So what I have done is, here is I have taken the profit before tax, I have added back the depreciation as per books, I am subtracting the depreciation as per tax, and then I multiply it by 30% to arrive at the current tax provision. So this is the amount of tax I would have to pay to the government. Okay. Next, I would I will copy this formula here, because every year it is going to be the same. See, every year current tax provision is same, because as per tax depreciation is allowed based on cost. Hence, even though you are claiming depreciation based on revalued figures, they will keep disallowing those depreciation based on revalued figures, and they'll keep allowing you depreciation based on tax rules, that is on cost. Hence the tax provision based on tax provision would be the same. Okay. Now here you have to show the deferred tax impact as well. First year there is no deferred tax impact. Second year there is a deferred tax liability which has been created, but it is not going to be shown here, it is going to be shown somewhere else. I have put 0 here. But third year there was a decrease of 7,500. I'll mark it as income. Now I'm showing it as part of expenses, hence I'll show it as income here, 7,500. Fourth year also there was a reversal, there was a decrease in deferred tax liability by 7,500. I'm showing it here. This is actually the difference in depreciation. I'll just give you the calculation here. How am I getting this? It is the difference in depreciation, the excess amount of depreciation multiplied by tax rate, that is 7,500. The same figure I'm showing here. Every year there was an reversal of 7,500, including the 6th year as well. 7th year onwards there was a reversal of 15,000 every year. How did I get this 15,000? I'll again show it to you. This is the increase in depreciation. The increase in depreciation was 50,000. 1,50,000 minus 1,50,000 into 30%. Now I'll show this figure in minus because it is an income figure, hence I'll get 15,000. So all these years I have an income of 15,000, that is reversal, reduction in deferred tax liability by 15,000. Now I'll try to arrive at the total tax expense. What I'll do is I'll include here total tax expense. This is equal to this plus the deferred tax impact. So I now get the deferred tax impact. Now I'll arrive at the profit after tax. Now profit after tax would be profit before tax minus the total tax expense. Okay. Now we come to the other income, comprehensive income portion of the P&L account. First year there was no revaluation surplus, there is no deferred tax liability, hence the total is going to be the same, 0. But in second year there was a revaluation surplus of 2 lakh rupees and there was a deferred tax liability of 60,000 rupees. I'll show it as minus, and then I get the total income to be shown in statement showing changes in equity 1,40,000. Here I am passing an entry revaluation surplus account to deferred tax liability account. Okay. Now in the third year there was no revaluation profit, hence everything was 0. Fourth year again it was 0. Fifth year again it was 0. Sixth year again there was a revaluation profit of 1 lakh, but there was a deferred tax liability which I created for 30,000. I get 70,000 as the revaluation profit for 6th year. So I'm showing revaluation surplus under other comprehensive income portion, and the related tax liability is also subtracted from the other comprehensive income. Here again revaluation surplus is credited to other comprehensive income portion of the P&L account, and this deferred tax liability impact is also shown here. Okay, 7th year onwards there is no revaluation surplus and there is no tax liability on such. Okay, so now we have finished the P&L account. So now we come to total comprehensive. This is the other comprehensive income, 1,40,000, 70,000. This is after tax. Now total comprehensive income would be sum of PAT plus the other comprehensive income. Now we come to statement showing changes in equity. If you see the format here, it is, we are taking first retained earnings. It will consist of opening balance, profit after tax for the current year, transfer from revaluation surplus if any, and then closing balance. Then we are taking revaluation reserve, opening balance, surplus found in the current year, transfer to retained earnings. In our earlier lectures we have discussed that every year a portion of the revaluation surplus has to be transferred to the retained earnings. The amount is equal to the excess amount of depreciation charged net of the tax impact. So some amount of revaluation surplus is transferred to retained earnings every year. So let us start. Opening balance of retained earnings was 0. The current PAT is equal to 2,80,000. Transfer from revaluation surplus would be coming from this particular account. Transfer to retained earnings, it is 0. Closing balance would be opening balance plus current year PAT plus current year transfer from revaluation surplus. It will be 2,80,000. Opening balance in the revaluation surplus was 0. Surplus found in the current year was 0. Transfer to retained earnings is 0. Closing balance would be equal to opening balance plus the surplus minus the transfer to retained earnings. Okay. Now second year opening balance would be equal to closing balance of first year. The current year profit would be, current year PAT would be 2,80,000. Transfer from revaluation reserve, again in the second year, once we fill up the revaluation reserve column here, automatically this figure will appear. So closing balance I can copy here. Now opening balance was again equal to the closing balance of the first year. Surplus found in the current year, this is equal to the other comprehensive income, that is the revaluation surplus which was credited to P&L account. This will take here. Transfer to retained earnings during the current year is 0 because this was done at the end of the first year. The closing balance would be 1,40,000 only. So again transfer from revaluation surplus is equal to whatever has been transferred from the revaluation surplus, hence it is 0. There is no transfer here, so something has to be transferred from here to here, which is not there in this problem. Okay, so we can now copy these figures here, Control C. The closing balance for third year becomes opening balance for the next year. The PAT figure automatically comes here. This is the transfer from revaluation surplus, this is the closing balance. Now we'll again copy it here, Control C. Now surplus found in the current year is 0, but transfer to retained earnings, how much are we going to transfer to the current year? This we are going to transfer. We can simply take it as the excess amount of depreciation charge was 25,000, or we can say like this: depreciation after revaluation is 1,25,000, before revaluation was 1 lakh, into 70%, that is after tax effect we have to include. So this 17,500 will get subtracted here and will get 17,500 add here. So I'll put this in red, that is means it is transfer, and I'll put this in green, that means it is transfer. Okay, transferred, this is transferred, this is from where it is transferred, and this is where it is transferred to. Okay, so we can see the next year as well. Automatically the figures will get copied. Now opening balance for fourth year, if you observe, opening balance for the fourth year is closing balance for the third year, which becomes the opening balance. Surplus found in the current year was 0. 17,500 is the transfer to retained earnings. This year also it is the same, 1,25,000 minus 1 lakh into 70%, it has been transferred. This is subtracted here and this is added here. Fifth year again the same thing happens. Now again 17,500 is transferred from this place to this place. Now I'll take for sixth year also. Sixth year also it is the same, because in the sixth year as well depreciation as per books was 125, historical cost was 1 lakh, excess depreciation charge was 25,000, net of tax effect we are going to transfer 17,500. See, you can observe here that in the profit and loss account, if you observe, in the sixth year we have shown 7,500 as income here, that is reduction from tax expense, and we are showing 17,500 transfer from revaluation surplus to retained earnings. That means 17,500 is transferred to profits here, and this 7,500 is also profit. Hence 25,000 is being transferred from revaluation surplus to retained earnings indirectly. Okay. Now in the seventh year we'll continue again. As I'm not able to see, I'll just hide some rows so that it becomes easy for us. Now in the seventh year again the figures will continue, but in the seventh year the transfer from revaluation surplus to retained earnings would change, because now the depreciation figure is not 1,25,000 per annum, it is now 1,50,000. So I will take 1,50,000 is the depreciation based on revalued figure, but 1 lakh is based on cost. Net of tax, I have to transfer now 35,000 every year. Now if you observe, this 35,000 is shown as income, another 15,000 is subtracted from the tax expense. That means 35,000 and 15,000 and 35,000 will become 50,000 again. I have to again unhide this. If you observe, in the seventh year you are subtracting 15,000 from the current tax provision. That means you are taking 15,000 as income, and again you have transferred from revaluation surplus to retained earnings 35,000. That means you have shown again 50,000 as income in our reserves, okay, which is nothing but exactly equal to the excess amount of depreciation charge. As per the standard, from revaluation surplus you have to transfer to retained earnings an amount equal to the excess amount of depreciation charge but net of tax. Okay. Now from 8th year onwards there is no problem for us left. So the figures will remain the same. Again 8th year also 35,000 I am transferring, that is 50,000 after tax effect. 9th year, tenth year, and if you observe, by the end of 10th year the entire revaluation surplus has been transferred to the retained earnings. So this is how we are going to show the effect of revaluation on various parts of our financial statements. Thanks a lot.